Let's bring into play my panel for this hour. In studio with me, Peter McGuire from XM.com, and from the West, Rob Briley from Patterson's. Happy New Year to you both. Rob, great to have you with us. Pete, welcome into the show. And, of course, everyone is wondering, really, the same checklist that we ended the year on. Nothing has changed other than what, Peter?
Nothing has changed other than the start of the OPEC cuts as of Sunday, what impact that's going to have over the first couple of weeks, leading, of course, into a fascinating month in itself. Trump administration, inauguration, China as far as Golden Week on the 27th, 28th of the month. So I think we're going to see a fair bit of volatility and quite some interesting plays as far as trades are concerned over the next couple of weeks.
OK, and to that mind, Rob, bringing you into play, as you await company earnings even and perhaps latest projections on matters, what do you look for to justify these now elevated prices, the pushback well off the brink position that they were in Feb of last year to really, some would say, overpriced? How would you judge it, the pricing on the majors?
Yeah, I wouldn't say we're overpriced, but there has been a reallocation of funds. You've seen the cyclical stocks really gain favour over the last couple of months, and to the detriment of you know, the likes of the property trusts and the utilities, which have been going in reverse due to this, you know, this bond yield play that's happening at the moment. So you know, we're certainly not cheap value, but I think you know, that there is enough value in the market to suggest that we could have some impetus coming into earnings season. OK, now, overlaying all of this, and credit where it's due, Bernstein putting its crystal ball out on the table and polishing it off, giving us the benefit of some of their calls. To your point, Peter, on OPEC, let's just pull this one apart briefly and maybe put it up on screen as a summary view that they're saying. They're talking about being close to backwardation, the market of it in itself. So that does signal an undersupply. That much we know. You've already called out, though, quota compliance. Just want to clarify, quota compliance. How do we measure this? We have Aramco due to list. It will, by its prospectus, be forced. As
far as disclosure?
This is right, but bigger picture, OPEC disparate membership, how do you go out and actually get a read?
Well, that's going to be fascinating in itself, how it plays out. You've got the likes of Russia. We all understand all are producing, most of these member countries and non-OPEC producers are at record levels. So they have put a line in the sand and said they'll cut back so many 100,000 barrels per day, and it's over a discovery mechanism. It's self-compliance. It's a regulation that's going to have to be adhered to, but more importantly, across the framework as far as OPEC's concerned, their hands are very much on the wheel on this one, and they've got, I think, a hand on heart from all the members and non-members to say we will adhere to these cuts. We all understand what we're trying to achieve, and it's going to be, I think, over the next 3 to 4 weeks, fascinating if they adhere to those cuts.
There's a link, of course, always is with the uses that we put this commodity to. Rob, Bernstein's view on this, the risks of China and India on demand from weaker car sales and demonetization policies, as it happens, could weigh on growth. That's a clear live concern. Where you sit, Rob, in that, even in that environment in Perth, the rage is not crude. They're all talking lithium, of course, and so the great disruptor to the auto industry, and by extension to the very fuel that powers these gas guzzlers.
Of course.
I mean, where are we at? Just is 2017 too soon to be jumping over from old energy to new?
Well, I'd say that you know, we are in differing times, and certainly lithium was the commodity, one of the commodities of 2016, I suppose. You throw in that a very old commodity like coking coal, which also did fabulously. So I think it's all about these supply and demand fundamentals, and we've seen a number of things play out. You know, we've got the surprise of the iron ore market, which has held up extremely well. Why? Well, I think it's because Chinese supply has diminished at such a rapid quantity that it's rebalanced the market quite quickly. So it's all caught people by surprise. So China's a big black box. It's a X factor. It's a very opaque market. We never really know what's going on. There's on occasions there's stimulus of a type from the government. Boosting infrastructure spending. The property market's been going up and down like a yo-yo, and that's really been driving industrial metals and also steel demand. So it's a very convoluted sort of scenario at the minute. But I do believe that China will continue to grow and will continue to be an engine of demand. It's really up to the supply side to stay sort of relatively disciplined, and we've seen that in some of the markets. And as you were alluding to when discussions about OPEC, I mean, it all depends on their ability to stay disciplined, and it's quite a fragmented supply market, so it's very difficult. Whereas the iron ore market is very concentrated.
Let's talk.
Very much so.
Let's talk where it matters, and just stick on Rob for a sec with a stock-specific view. And the call out from Barron's. They single out, Rob, on the ENN front, the E&P front rather. So the exploration and producer, I suppose, league tables that they have singled out. Oil Search and Santos rate a mention alongside Impex, Sanook, and ONGC. So here we have a clutch of Australian producers and explorers called out for a top pick for 2017. Is that pretty much aligning with your views on the sector?
Yeah, not quite. I mean, I think Santos is a very risky play. It's still sort of sorting itself out. It's, the new management team have got a new strategy in place now. They're doing an extra capital raising, as you know, and hopefully that will help to strengthen the balance sheet. But our preference is we like Oil Search, and we also like Woodside just for its safety and security and pristine balance sheet. So at the moment they're our favourites at the moment. Woodside and Oil Search. Santos just a little bit too risky for most of our client base at the moment.
Did, to your mind, the shake-up at board level on Santos last year, did that fundamentally reset expectations across the company, or more is required? Because simply switching out of one CEO to another, again, we ended last year on will they, won't they, cap raising that you just called out. It seems as if the market's been there before. I'm cautious to say misled, but equally there was a perception that we were told one thing in an investor presentation, and then something completely the opposite was brought to markets via the cap raising a week later.
Yeah, look, Gallagher, took the reins in February, and he really took his time to understand the strategic value within the portfolio. It's quite a diverse portfolio. I mean, most energy analysts will tell you that their asset base is probably not of the same quality as the Oil Searchers or the Woodsides, for that matter. So, and they were caught, at a cyclical change when the oil price fell out of bed with very high debt levels, and I think that's always a bit of a crunch. You look at something like Arium in the iron ore space that went belly up because of that as well. So Oil Search have managed to survive by doing these equity raisings, but the management group has taken quite a while to understand the business and to communicate its strategy. I think that is a function of how complicated and difficult the asset base was to really wrap their head around.
And because you are a marginal producer, Pete, like Santos,
yep,
you don't have the hedge offset of something like the LNG of an Oil Search.
Sure.
You are basically in the vice-like grip of that tick up or down in the
fluctuation
price,
of the movement of the price. And as we've seen, as Rob has mentioned, we saw that the meltdown, not only a meltdown, but when you look at what happened as far as Saudis, what's happened to Russia, it's really been from balance sheets, deficits. This has been a global phenomenon, and this is the undercurrent why all of these, not only countries, but more importantly the producers and for their shareholders, need to band together to get some sort of action. Because I think that if you look at it and analyse it, we're in for a very interesting 10 to 15 years. New technologies, innovations, new ways of doing things, and from the Teslas all the way through is going to disrupt change? And are we heading to that dawn of the fourth industrial revolution, let alone the third?
Well, yeah, just think Uber, cab charge and jump from
Airbnb
one sector to another, correct.
Yeah.
And hotels, good luck to you. But, Rob, when it all is said and done, you've then got Sanook just quietly doing it for a third the price. I mean, I'm exaggerating, but you get my point. You're in recession in the West. How do you move the needle just on other sectors as you walk even down St George's Terrace? You know, how do you believe that the lease signs there are going to go to full to overflowing again when you know we cannot produce any of these commodities and pull them out of the deep seas or wherever at any fraction of that price that China does?
Yeah, look, it's a difficult time in WA. It's clearly an economic rebalance. We've got an election in another 2 months as well, which is going to just create a little bit more business investment uncertainty. There's quite a extreme sort of disparity between political groups and even minor parties, and we don't know where Pauline Hanson will stand in all that. But there's still job cuts going on in the majors. Clearly, we've transitioned from a construction-led economy to a production economy. There's still a lot of production to come out of WA, particularly in the iron ore and in the gas fields.
And you're actually, on that point, it's interesting because we laughed at the time when Gina was quoted as saying, "I would rather my workers were, you know, getting $1 a day." Now, she didn't say that, but you know, to her point, really, her bigger picture point, you cannot live with this largesse for any length of time and believe it won't all come crumbling down. Well, it has come crumbling down. So she's had the last laugh.
Yeah, well, I mean, you know, I suppose equilibrium or common sense will prevail, and we were in a terribly overcooked economy there for a while, where we had the iron ore producers fighting against the LNG producers during the construction period. We even had the government doing major infrastructure works during this time of buoyancy, and it really created that competition for the human resource, and that really sucked a lot of the economic growth out, I suppose, because we were in an inflated sort of cost environment. Now that cost environment has moderated. Clearly, the commodity prices now have started to moderate. So I'd expect a pick up in construction activity, but you know, I think there's some cautiousness ahead, and it's going to be led by the majors because they were really the major contributors to that overcooked environment. They were the ones pushing up prices.
And a line in the sand before we go to the break, gearing levels more broadly. Bernstein was saying, actually, in their view, the cap raising by Santos, the latest one, was unnecessary, but at least it brings gearing down to 30%. Now, is that the kind of level that we should be saying that's it and no more across this industry now?
Well, that's a hard one to say because you've also got currency manipulation or currency fluctuation, dependent upon which country you're going to, if the China's or the Aussie dollar. Then you're seeing what's happening as far as a global push as far as that US dollar. We're in a low interest rate environment, so you've got to say at 30%, what are you paying as far as debt? What's it costing you? And what are you retrieving? And is the asset that you are retrieving, is it on a bullish uptick or is it going south?
And the lessons when you don't invest, a la the Iranians, dormancy...
you bet. Have a look at countries. Have a look at what happens. So you can get behind the curve and then it's a catch-up and then you'll have to spend considerably more as the asset price actually increases.
Okay. Let's pause, reflect. When we come back, we will be talking some of those other calls out on levels for the precious metals and for gold and for oil as well. That's next in our discussion. Stay with us. Welcome back to the show. Going into the iron ore space now for you with my guests Pete McGuire from XM and Rob Briley from Patterson's. That was the performance today of that material space. A bit of a checkerboard, wasn't it? With Rio running the opposite direction to rival BHP. Incidentally, in London, we did see Rio off the mark, down some 0.7%. BHP spiking almost 2% there on the FTSE. Fortescue holding its own there, middle of the charts, but the outperform story again Unshon Atlas BC, good night, down some 3% now. Yep. Let's also just quickly whip through the oil producers. We were talking about Bernstein's prognosis on some of the E and P plays here, but that is the finish out, 55.87. That was a figure, was it not, Pete, that seemed like the electorate fence until what, OPEC meeting 2, you were at both
exactly.
OPEC, well, the first OPEC meeting.
Exactly right. So we saw a market that had 4 or 5 cycles over a 2-year period with the hedge fund players, and those trades were anything up for the 6 to 10 week cycle. They moved markets tremendously. The hedge funds did extremely well out of that positioning, and they've taken realised quite simply that the OPEC and non-OPEC, they banded together, got the put a line in the sand and said what their cuts are going to be. The hedge funds have moved forward. We've seen the market up 15 to 20% since the end of, I think, the 21st or 22nd of November, and it's been a solid uptick.
All right, well, Rob, using that logic, but taking it into iron ore and the price run-up we've seen there, the connection not with the hedgies so much as the Chinese punters who've been dissuaded and told not to play in the equity pool, go into the spa pool that is iron ore and, you know, play to your heart's content. How much of that is skewing the price?
To be honest, I think that surely that's having a impact for sure. But I suppose on top of that, you're coming into a very interesting season. We've got cyclone season in WA, we've got rainy season in Brazil, and we've got you know, the Chinese New Year coming up. So it's a restocking period at the moment. So you see the stocks have risen quite a bit lately. So I'd expect the iron ore price to moderate. But I suppose the possibility of a supply shock through either really bad weather in the Amazon region of Brazil or major cyclones in WA has increased substantially. So that shouldn't be discounted as well. So I think that's a short-term supply issue. At the same time, we've got Vale's S11D project being commissioned at the moment, a large 90 million tonne per annum new project, highly automated, very low cost. So that's going to bring the cost curve lower. So, you know, we live in interesting dynamics. I can't see the iron ore price staying at this high 70s, $80 mark. I think it's going to moderate to the 55 to 60 mark.
Yeah, to your point, and steel analyst at China Sublime Information Group calling out the seasonal drop-off in construction in the winter months. But you know, what goes down and everybody then springs up. It's a bit like, those daffodils, is it not? You know, you prepare for an uplift. So are you concerned at these wires that seem to come in week on week about gluts in infantry sitting there, literally rusting on port side? Is that just a short-term phenomenon, but we see it every year? Pete?
We see it every year. We see commodity markets do this. It's seasonality. When you look at, the likes of technical analysis, fundamental analysis, and then, of course, the seasonality play, different times of the year do different things. People say, well, what price do you think iron ore is going to be? Well, please tell me a day and tell me nearly to the point of tell me which hour, and we'll be able to speculate or get close to that number, because you've got such big movements and many externalities that can greatly impact.
Then again, Rob, it is a matter of life or death, literally. And Peter, I know you've been up there. Rob, I know you yourself ventured to Beijing, I'm sure, and just coughed as you walk out of your hotel, because you are, you're getting, it's like apocalypse now, isn't it? That filth.
Same as India.
Blackness.
Some of India. We've got 23 cities in China red alert as far as pollution.
So that prompted, of course, the coal cutback last year.
Exactly.
Is that only going to intensify this year?
I probably will. Look, the demand as far as energy from electricity is just astronomical all across that region. And until you change technologies, whether you go down the pathway as far as wind, nuclear or whatever, but I think you've got many years to run until things change. Right. So at least another decade.
Rob, do you see that time horizon and therefore the fortunes of the producers here being...
It's a long time horizon, because it's analogous to trying to renovate your house while you're living in it. China can't stop growing. It's got a massive population to feed. It's going through this urbanisation program. It's got to keep on growing. So it realises, I think, that it needs to change the way that it does things. So it's it's slowly but surely bringing in environmental standards that are, first world. But they can't just turn it upside down and create a major disruption to their economic growth. So they need to do it in a measured way, in a calculated way, and they will be doing it, but in between times they just can't afford to stop that economy from growing. So you're going to get these fits and spurts, which we're seeing all the time.
Well,
I've noticed
yeah, that's a very good point, the fits and spurts argument, because at the start of last year, you get a real sense that the leadership came out explicitly and deliberately to call out their commitment to infrastructure.
Yep.
They put that marker down, but at the same time, sort of running in tandem is Xi Jinping's own pet project on corruption. Now, you talk about disruption to models. Rob Briley, where you're sitting, you've got Crown's edifice to Capitalism 101, gleaming towers, car parks that rival Sydney airports, but it's for one company. All right, this is the proposition that they've built it on, that build it and they will come. Is that, to your mind, in the West, still a rock-solid business case, given what we saw at the end of last year?
Well, I don't know about rock solid, but I mean, I suppose it's a method, it's a way of making things happen and keeping that sort of that growth going. So it's not without risk, but I think it's a way of keeping everything growing, Carson.
Okay, so that growth story, Pete. I mean, when you look at on the one hand, the ability to be nimble as a command economy and just snap your fingers and get change, but also some of the fallout from it. Do you think we are learning lessons? You know about event risk, key man risk on boards. I mean, are we seeing too much of a kind of after the event, oopsie daisy, we should have done things differently? The list has been building up, if it's not into the casino side of the businesses, but always on borrowed time, let's face it. And they have had to adapt because, Macau was only so good as they wanted it to be.
Of course.
At the centre. But what about even things like the Bellamy's of this world, where, we've got boards ostensibly with great skill set.
Of course.
When the rubber hits the road, it's lights out.
Well, sometimes, and I'm not going to talk too deeply about Bellamy's, but I'll say this. Boards need to have a hands-on approach. They're the stewards of the company. They really are they're the ones that can be charged. They're the ones that can go to jail. They're the ones that have got corporate careers that oversee the value of the business for the stakeholders and for the shareholders and the employees. So they've got a duty of care and they need to manage that appropriately. It's easy to look in the vision mirror and say, look, we really didn't see that one coming. They're risk metrics, and you need to analyse and look at what business you're in environmentally. If you look at mining, have a look at some of these like catastrophes that we've seen as far as Deepwater Horizons. Have a look at what we've seen as far as BHP in Brazil. So there are some major impacts all across the world, and you'll only see probably more of them with new technologies and, of course, with new agendas coming into play like Trump.
And ironically, BHP's going into the Gulf of Mexico and JVing really in that zone where BP, not BHP, came unstuck, to your point there. Rob, just back on the China-facing story from another angle, the Bubs listing, which is now 48 hours old, a 51% rally today. And, OK, they brought in $5 million on day one, as intended, but importantly, finishing at I think about a 30% premium. Now, that's just a marker, is it not, that not everyone is tarred with the same brush?
Well, yeah, exactly. And when you've got a sort of a micro-cap story that emerges, it's it's ironic that while Bellamy's are in all this sorts of trouble and unable to really communicate with the market to tell them where they're heading and where sales are going, you get this little company coming out of nowhere, recapitalising, going into a shell. And I think that the listing price was they did the raising at 10 cents, so I think it finished at 21.5 today or something like that. So we've seen a doubling or more than doubling of its market cap over 2 days. So yeah, great little emerging story. It shows that people are still interested in that segment. I think the issue with going back to Bellamy's, I think when China has demand for something, it borders on being insatiable. It really is. It's insatiable, and it's very hard to. So, what do? Do you feed the beast, or do you slowly measure yourself out and do it in a way that's more balanced? And you know, while your shareholders are saying, "Why don't you grab more? Why don't you do more?" So they were caught between a rock and a hard place.
And yet, where are these individuals? We talked about boards, hands-on. Where are these officers in these markets? Do we know that any of these companies have a boots on the ground, or is it all being done from either the comfortable distance of Hong Kong and believing that that's China? Well, don't kid yourself, it ain't.
No.
Or, Rob, are they actually there where they need to be, where their customers are, where the officials are?
I suppose you can't talk generally. You can only talk generally. You can't talk specifically. But a lot of these people use middlemen, marketing people, or sort of brokers, like affiliates,
who have no
really
real loyalty to you. They are basically promiscuous. They've got 6 others on the go as well.
It's no different from when iron ore got really hot and all these iron ore traders came out of nowhere and were happy to do deals, invest in small companies, do off-takes. You've seen it all the way through, and it's no different from, infant milk powders, vitamins, whatever. They're altered. Yeah.
And take a breath and then just pause as we go into the break. The news this week that Clive Palmer's planning to build a coal mine. To just summarise all of that and just ponder it, reflect, and we will come back after this short break. Stay with us. Welcome back into the show. Rob Briley from Patterson's in Perth, and indeed Pete McGuire from XM.com on the show today. But here are our top stories to update you at past. That was the finish today. Second day back for the new year, and back-to-back gains for the 200. Not the place to be if you're on that register, sorry. Hunter Hall shares again under pressure, updating the markets on its takeover attempt by Washington H. Soul Pattinson. In other news, and Bellamy's a major shareholder, one of them, has come forward and talked about the need for management changes. That man, though, the chairman, saying the change, if it happened, would simply be too disruptive, so forget it. Incoming US President-elect Donald Trump tweeting again, threatening General Motors with a big border tax if it continues to import cars from Mexico. Bringing the panel to that one, and just wondered the connection, alive and well, pre-inauguration. He's claiming credit for jobs and growth already. OK, fair enough. There was a development that gave credence to that. There will be a move back by at least one auto producer to home territory.
Yeah, I saw Ford looking at doing some work, and they're going to bring that technology back to Michigan. So no doubt that he's rallying these guys. They're not going to... That's the difference, and I've got to say this, the Trump mantra and the way of doing things. He's got billionaires on board, and they're not used to hearing no.
Right.
So they say, well, you need to do this. If you're not prepared to do it, there'll be taxes, tariffs, you name it. And we'll go and talk to your CEO, we'll go and talk to your board, just get them to fly in and we'll give them an hour. If they're not prepared to act accordingly, this is for the betterment of the US, then I think there's going to be some fun and games.
I mean, well, fun and games, even at a kind of keep your hands clean level, is the chatter as well alongside what you were just saying, Pete. I mean, Rob, is it even possible that all this optimism is cut short awfully quickly by, dare I say it, an impeachment coming preemptively? There's so much temptation out there. As if you're part of the Trump tribe, to all of those billionaires, I mean, heads up on the tweet, buy the shares or sell them, whoopsie, off to the races.
Well,
I mean, Twitter didn't exist when Barack came in. It does for him. He won on it.
Sure, but we've seen a very strong rally over the best part of a month and a half, or 2 months, I should say now, since about the 6th or 7th of November.
And that's really interesting as well for market pricing, because it was always basically selling on a Trump spike in popularity, wasn't it, Rob?
Yep.
Then you got basically the belief Hillary would calm the market. If they misread that, what does it speak to now Europe that's ticking with France, with
Le Pen?
Exactly, that election unknown, the Italian banking situation not resolved.
Greek banking
is on the docket. Germany in September.
Yep, so, Netherlands.
I mean, how do you trade that one, Rob? What are you going to do? Just sit back, crawl under a rock, or what will you be doing? Active or passive investing?
Look, at the moment, it seems like, all this sort of so-called uncertainty is taking a back seat to the fact that people are quite, I suppose, excited or refreshed to see a soon-to-be president being a strategic sort of go-getter rather than someone that spends half their time watching their back and making sure that they get trampled on by lifetime politicians. So, in a way, it's refreshing. And whether that enthusiasm is overplayed, you could argue that perhaps a lot of exuberance has been priced into the market, and the reality will be that as he gets into that political slog of actually trying to get things done, it may well slow the progress of this renewal of or repatriation almost of US economic growth.
And I'm sort of proxy for the haters that are alive and well that never wanted this to happen.
Yeah,
but
and there's a few of them.
There is a few of them who continue to say, look, until he sells his company,
sure,
the temptation for the Saudi prince to have to stay at Trump Towers is simply too alive and well to not trigger the profits and therefore the self-interest versus the national interest.
Sure.
That he'll be using US policy to gain and not really to do anything we believed he would do, even on infrastructure. I mean, how do you see it? It's been
Look, how do you...
what is it?
You've got to take a man on his word to some extent, quite simply. If you've
doesn't
removed...
show tax returns.
No, well, true, but I think there's still reason for that, and I don't think he wanted to come clean with that $1 billion loss from the casino, so in turn he had that tax write-down for 17 or 20 years. But the next part of it is that if he's putting it with, as far as the trusts or having his children manage these, and of course his own team of management, then he's got to be trusted to some extent to say, right, this is where my role is. I'm spending 15 to 16 hours a day on this. I'm working my 100... I think he's a workaholic.
We wouldn't accept this from Malcolm Turnbull.
No,
he had
different style of personality completely.
Trust.
Different.
But he was from the markets. He was a man of. He was from.
Yes, a privileged upbringing. Whatever. Absolutely. Yeah. So yes, there is. That would be the only similarity. I think they're very much different people. Okay. And moving forward, I think Trump is far smarter and far more strategic than Malcolm Turnbull could ever be.
Point taken. Let's talk specifically then on the link with industrial commodities. And the list is there before us: aluminium, copper, zinc, lead, nickel. Rob, they're the old sort of LME mainstays, but I mean the numbers that you're seeing of late, because now they're complicated by the temptation of those Chinese investors yet again to be in on the action. Even the Russian investors. I mean, pick your billionaire. They can be in on this. What are you saying the rises really represent? Is it a belief in China growth? Is it a belief in the Trump infrastructure story, or a bit of both?
It's a bit of both, in my opinion. I think clearly at the start of last year, there was some major worry about China having a hard landing. Clearly that hasn't happened. They've managed their economy well. I suppose the benefit of being a communist country is that they don't have to spend time politicking. They can just manage the economy, and they seem to have navigated their way through a tricky period, and the regime transition as well. So now China seems to not be a hard landing story. In fact, it looks like it's regenerating itself. And now it's also the US economy, coming good as well, and then perhaps Europe will join in, and everything else will be all hunky dory. But I doubt whether it's going to be a one-way ticket to the stratosphere at this stage. But I think there's certainly a lot of positivity out there built into the current share markets, and they're contingent on Trump and the Chinese regime making it all work.
Well, look no further than the greenback and the rally on that one to sort of just act as a metaphor for that.
That's a wake-up call.
Where do you get demand destruction kicking in based on that? Quite simply.
Where do you get it? Well, you've got possibly 2 rate rises this year, and maybe even some are saying you could get one towards the end of the year to make it 3, or certainly early in 18. So I think that's going to underpin this value of the US dollar at the current levels.
In the last 2 years, we were talking about 4 and 4.
Yep.
We scaled that back to 1 and 1.
1 and 1, but this year I think it's, the momentum.
On one, didn't they? They only locked on one from the September forecast to then Trump's win. They only added on one more dot plot.
Yeah. So if that can continue with these sort of levels, let's see what happens as far as the manufacturing costs. The strength of the dollar's got to play into all of that as far as US exports and what Trump is able to achieve. His first 100 days are crucial. It's going to be fascinating, wonderful to watch and observe. As I said, he's a CEO that's hands are on the wheel. He goes to work, I think, every day for all day, and he's going to make things happen. And I wouldn't like to be involved, or wouldn't like to. He's not the sort of guy to say, "I don't think we can do that, Mr. Trump or President."
That's true. But do you really think he's prepared for an 8-hour day?
I think he's an 18-hour day.
On his own interests, but these
not his own interest. I think it gets to a point that if you've got many billions behind you, you can buy a sandwich for today. And he doesn't drink, so he doesn't have to buy a bottle of champagne or a bottle of beer. All he needs is a sandwich, and he'll keep going, and he'll make it work. And I really feel he wants to go down in history as a turnaround king.
Okay, just get the restaurants humming though, because the ones that have been reviewed in the Tower sound absolutely foul. Prefer Nobu over those Trump sandwiches or whatever. I mean, talking, Rob, to your views on the China story though, what is now going to be the next, I suppose, barometer on the prices that are being bid up on the iron ore story? What do you look for this year? The first kind of signalling to justify?
I think the first kind of signalling will be what happens post the Chinese New Year. They go into holiday mode in the next week or so, and the economy or the market demand it sort of goes to sleep for a while. And whether they emerge with the same sort of exuberance, or whether there's a pause in some of this property boom that's going on, and this infrastructure boom, which will really play out. So we've seen the steel prices go up for a change. That's helped with raw material prices. Obviously, coke and coal's gone up big time. Iron ore's gone up as well. So I wouldn't be surprised if we had some moderation in prices. But I think that's fully factored into the likes of FMG, etc. I mean, if I ran $80 through my model on FMG, I'd get a share price or valuation of $8 or $9 easy, probably more, probably 10 or 11. So there's certainly people who are factoring in this pullback. When it comes, I don't expect a capitulation in the iron ore sector, but I think it will be good in the long term to see some moderation there.
When we come back after the break, is it necessary and good to see moderation in prices on lithium? Orocobre went up 71% in a very short space of time last year, and we're left wondering where to next, even in light of its connection to markets offshore, not least of all Argentina. We'll talk that with the panel after the break. Welcome back into the show. Rob Briley from Patterson's, Pete McGuire from XM with me from East and West Coast, so coast to coast on Live at 5 today. We're getting into the tail end part of the show. Want to tick off, panel, the idea of some of those metals, the industrial metals that aren't often talked about, but they're getting noted and they are rising on expectation. The likes of Orocobre, about a 71% rally to mark the end-of-year performance. Galaxy with an Argentinian connection as it looks beyond borders for more of that stuff. I mean, it all comes back to your earlier points on Tesla, the promise of alternatives to old energy. What do we make of it? Pete, your view at the moment. Well, 2017 story or later? Jumping the gun? It's got
to be a story now. If you listen to the likes of Elon Musk and what what he's projecting as far as trains, automobiles, every form of transport, rocket ships.
Sounds like Arthur C. Clarke.
It does, but when you think of what's happening as far as roads now, and I'm seeing solar panels on roads that are going to attract the energy, feed straight into the vehicle and power it along, so maybe that's the new frontier, what's around the corner. the world is a changing place, and this is where those incumbent players, and we can always say, well, look, the board didn't have their hands on the wheel on that one, but leapfrogging of technologies, and you can be left and all of a sudden you're standing at the gate with nothing. So you've only got so long until technology and innovation is the leapfrog as far as mathematics, sciences, and that's where China and the releasing of patents. So you need many engineers, or many hundreds of engineers, looking at new ways to do things. That isn't going away. OK, well, applying it to the stocks under discussion, we flashed up one on Galaxy. Rob, just do a compare-contrast briefly, if you could, say, between an Orocobre and a Galaxy, given one's got that offshore sort of murky connection on Argentina, not yet sort of clarified to markets to their liking. What's the problem there?
Well, I suppose just going, Orocobre is in production, and so is Galaxy. Galaxy has a small hard rock mine in WA, which it's just brought into production, and it's got an undeveloped asset called Sal de Vida in Argentina, which I think it's looking to try and sort of you know, find a way of commercialising, and probably the best way they could do that is to joint venture that out to a major, either a major customer or major player, similar to what Orocobre did to get into production. They partnered with Toyota on their mine. So I suppose when you're thinking about if a commodity's hot, the first way to play it is to look for a producer, and clearly these two companies are producers. A lot of the other ones in the space have sort of are trying aspirants to be in production, and we all know that will take 3 or 4 years to develop. So if you cast your mind back to the iron ore boom, you know, there were only a few real successes. FMG is clearly a success. Atlas has had its moments where it's been successful and it's been in the doldrums, but very few other aspirants actually made the move into production, and then have all sort of petered away. So, you know, quite rightly, the investment dollar has really concentrated on the producers, or the here and now producers, or the near-term developers. So it's been an interesting space. It's played out rapidly. I agree with disruption, but disruption could also be an issue, because lithium-ion batteries could well be replaced by something else in the next 4 to 5 or 6 years. And if that happens, then what have you got? You've got yesterday's hero commodity, really. You know, similar to lead or some of these other things that have died a little bit. So
past their use-by date.
Yes, yeah. So, you know, it's you know, we forget that 8 or 9 years ago, there was no such thing as an iPhone, and how disruptive and how much of a change that's been. OK. Uber.
Well,
yeah,
you're right.
It's changed.
Let's tick off another stock, Paladin, because I'm noticing, and this is a bit of breaking news, Rob, just to throw at you, but still, I know you can handle this one. Talking about, you know, in other markets where it has potential funds from, certainly from an EDF arrangement. It seems that trade journals reports again. This is a case where a stock today, like Paladin, fell about 3%. It's had to come out and say the media articles, and they haven't pinned it on one, but now a multitude, I mean, welcome to social media, are misconstruing, are misrepresenting what they have been basically receiving in terms of additional funds from an EDF that they have. Can you just sort of explain away why that's an important thing to note and not be moved by when you are sort of getting a flurry of sort of half information a lot of the time, particularly when these companies have arrangements in foreign jurisdictions?
Well, Paladin's a very interesting story, because we're talking about commodities you know, that had their glory days, and clearly uranium had that. Paladin took advantage of that and raised some money and got production going. The failure, in hindsight, was that they actually used debt rather than equity to fund these projects, and have got themselves into a pickle where they've got really too much debt on their balance sheet, similar to Arium, and maybe analogous to a Santos or an Origin that got out of jail through capital raisings. But it's tried to do its best. It's tried to collateralise or find a way of actually making money out of their asset base by selling it off piecemeal. But I think they've done that to the French, they've done that to the Chinese. And I think the Chinese can smell blood, I suppose, and probably have reneged on one, if not several, of the deals that they had going with Paladin, and that's put them under significant financial pressure and cash pressure. So it's a real white knuckle ride if you're a Paladin investor. And it's probably going to get worse before it gets better, but it will be up to management to sort of get their, to get out of jail with their shirt still on.
And your reference to sort of the glory day type focus on some of the commodities, that in this case uranium, are you saying that is yesterday's story to everything we just said before that on things like lithium? You prefer to be on the next train rather than that old one. What's your preference, Rob?
Well, the issue, I suppose, in hindsight, is who would have predicted Fukushima? And I mean, that really just changed the whole
global landscape,
fundamentals of the uranium market, and it flipped it on its head, really. And because of that, the uranium price has been under pressure. Because of that, there's nowhere to hide when you're a high cost producer, or they had some long-term contracts which they signed, which have rolled off now, and that's what's made it hard. They had these artificially inflated prices they were receiving for long-term prices, and they've all disappeared now, and they're basically not making any cash, and unlikely to make cash until the uranium price turns around. And the uranium price has been horrible.
Sounds like an oil rig producer in the States. Had to walk off at $60. He couldn't make $1. He's gone to work at Home Depot. That's just a classic example. That's price elasticity, and this is what happens. And you're going to back something, and all of a sudden external forces force you out of the market.
Welcome to Trickle Down.
Yeah.
So they call it.
Welcome to commodity trading.
Okay, there we are.
Venture capital.
Thank you, Pete. Welcome back to the new year.
Thank you, Carson.
Pete McGuire from XM.com, and to you, Rob Briley from Patterson's. Thank you so much for sticking around just briefly into the final count with another summary. So we'll be back after this break.